Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 22nd of February 2022 and we're publishing our 2022 gold price forecast. Now tomorrow and Thursday we shall be publishing our 2022 silver price forecast. So if you haven't done so, make sure you've subscribed to the channel and press the bell sign so that when that video is released you will be notified. Now today's video is a repeat of the one we produced yesterday. And so if you've listened to that, there's no need to listen further to this one. But of course, if you haven't, then enjoy. Now, one of the most looked out for videos in the gold and silver space are the forecasts given by banks, investment institutions, economists, precious metal miners, bullion dealers, YouTubers and bloggers, stating where they believe gold and silver prices will end up by the end of the year. We have no doubt that 2022 will not be a disappointment where that is concerned. The usual suspects, the pumpers as we like to call them, every year say, this is the year for gold or this is the year for silver. And we see figures such as $5,000 to $10,000 and sometimes $15,000 to $20,000 for gold and anything from $50 to $600 for silver. One of our best videos in 2021 was why silver will not reach $50 this year, and we were proven correct. Now on the opposite side of the coin, we have institutions often underestimating what actually occurs, but by nowhere near the same percentage that the pumpers overestimate. We often hear in the precious metal space about manipulation of prices, and we've always advocated that some traders, and perhaps many traders, do attempt to manipulate price in the paper markets, but not for some global macroeconomic Machiavellian purposes, but frankly to make a quick buck. Drive prices down, so stop-loss limits are hit, driving prices down further, so that these culprits can then buy at rock-bottom prices and await the inevitable rise. At the macro level, we did express some concern 3, 4, 5 years ago about the possibility of state actors helping to hold the price of gold down to enable countries like China, for example, to obtain precious metals cheaply. Now this is pure speculation, but many have commented and stated that this occurred to act as a quid pro quo for their purchase of US debt instruments, which were needed to prevent inflation internally. Whether that occurred or not, all that has happened is that the ever-increasing debt clock, which now stands above $30 trillion, has now led the US CPI figures to reach 7.5% at the last count, and even countries such as the UK are quoting inflation rates above 5.5%, with little sign of such figures abating without some harsh and possibly debilitating monetary and fiscal economic tightening. Now 2021 proved an interesting year, and one in which we, for the first time, as I recall since the channel began, got our annual gold price forecast wrong by more than 5%, which incidentally are many tens if not hundreds of percent more accurate than many of the so-called YouTube gurus, and more accurate than many economists predicted. But what was noticeable and notable is that we were, for the first time ever, over bullish, and frankly gave the COVID-19 and its impact too much credit for potentially undermining equity markets, which it did not, thanks to unprecedented levels of stimulus, and thereby not causing, which should have, people to flock to precious metals. Having said that, to some extent they did, but not to the extent to impact prices significantly. So this is what we said last year. Quote, so what is our assessment for 2021? Well, we have difficulty seeing gold fall back considerably from current levels. There is a potential for a drop to as low as 1600 at the extreme, and an extreme peak of 2300 at the other end. Though we are more comfortable in forecasting that gold's rise is more likely to peter out at $2,100 to $2,200. Frankly, we believe the main trading range for gold will more likely coordinate between 1,700 to 2,000, though it will be higher in the early months of 2021. As best we can ascertain right now, we can still see a rise in the gold price for the year of between 5 to 10%, which will give us a closing price of 2,000 to potentially just shy of 2,100. Still a positive result, but we still have to bear in mind that unless they collapse beforehand, both equity markets and Bitcoin cryptos will be competing for investor funds. Well, for the year, gold rose to $1,957 in early January and then failed to reach that level again, and at one point actually dipped as low as $1,683 and ended up closing the year at around $1,806, approximately 4% lower than its opening price. Interestingly, the average price for 2021 for gold was $1,799, or $1,800 to have a nice rounded figure. Now, on the physical side of things, total gold supply eased marginally, down 1% at 4,666 tons, its lowest level since 2017. Mine production recovered 2% over the year, but this growth was counteracted by a sharp 11% drop in recycling. Jewelry growth was almost universal. Gains were fueled primarily by India and China, but decent recovery was also seen across other regions. Bar and coin demand exceeded previous annual levels in both the US and Germany as investors focused on rising inflationary pressures and low negative real rates. But all that now is history. What of 2022? Well, at the time of writing this, which is the 21st of Feb, gold stands at $1,897, a similar level to that which gold opened in 2021. We've seen gold rise in recent weeks due to a mixture of rising inflation, plus geopolitical concerns vis-à-vis Russia and Ukraine, and the prospects of China considering similar action with Taiwan. So what have we taken into account in order to make this year's assessment? Well, of course, we have to look at 1. The value of the US dollar, 2. Envisaged mine supply versus prospective physical demand, 3. The existing price of gold and where it stands in a traditional calendar cycle, 4. How are alternate investment vehicles faring and likely to fare, for example equities, cryptos and bonds, 5. The prospect of rising interest rates to combat inflation, and of course, ultimately 6. Potential black swans. Now, at this point, we have to add that regardless of how experienced one is in this market, regardless of what brain and computer resources one may have at their disposal, no one really knows where precious metal prices will end up. That said, unlike most other YouTubers, we don't stick our fingers in the air and assess which way the wind is blowing, nor do we quote what we would like the gold price to be, nor do we look for what our favorite guru says and just copy them, perhaps altering the figures by a few percentage points. The latter is perhaps the most dangerous because most so-called gurus have a stake in the game, as many make their living from dealing with precious metals or by hyping up expectations by way of clickbait to gain views and attention. For us this year, and one of the reasons we left this assessment so late, is the potential of serious conflict between Russia and Ukraine and the possible consequences should an invasion take place. The after effects of such a move could involve gas pipeline closures, embargoes imposed, tariffs, capital and bank freezes, and God forbid counter-military action, all of which will serve to push gold prices higher than one would reasonably expect them to go. Equally, a backing off by Russia will cause gold prices to fall, and then the inflation versus interest rate equation begins to dominate. Now, we could show you a range of charts, as many in the technical analysis trade do, and try and convince you that the relative moving averages, the Fibonacci retracement values, and RSI momentum indicators based over a 1, 3, and 5 and 10-year cycle will point to price X. But frankly, whilst we use these tools, they are invariably wrong, though they appear to be based on most sound investment science. We can also undertake a quick and easy assessment of how much is likely to be mined versus likely physical demand, and derive an appropriate price based on the previous year or year's price action. And often we find this to be somewhat imprecise, often lagging rather than projecting with any degree of accuracy. Now, we make no apology for this, but we've stated quite frequently that we have ourselves devised an algorithm that has stood us in very good stead these past 7 years or so much so that, frankly, had we bet the house on our own forecasts and price predictions week on week, we would have actually made many millions, yes, millions of dollars a number of times over, even in a market that has, to some extent, proven laborious and uneventful. However, we do not trade day to day, and like many who follow us, just buy and hold. So please forgive us if we do not share this algorithm. Now, what is interesting to share, though, is that on a year-to-year basis, to this very day, gold is up $99. On a 3-year basis, it's up $565. On a 5-year basis, it's up $658. But on a 10-year basis, it's only up $119. But that is, of course, taking into account that 10 years ago, gold was very close to its then all-time high. Now, looking at the forecasts of many major banks, we have in fact rather lower forecasts for 2022 than the current price. Deutsche Bank, being one of the more bullish in this field, are quoting $1,750 gold. And ABN AMRO, one of the lower, are quoting $1,500. And then lower prices again in 2023 to $1,300. The World Bank is expecting the average price of gold for 2022 to rest around $1,750. Bank of America, by contrast, is expecting a positive gold outlook for this year, quoting an average price at $1,925, some 7% or so higher than the average price in 2021. Australian bank ANZ expect gold to find support in the first half of the year, but undergo downward pressure later in the year, a view that we have, when the Fed is expected to raise interest rates. They wrote in their latest commodity report, quote, "As ultra-loose monetary policy nears an end and stimulus starts to shrink, support for the precious metal sector is likely to wane in 2022. However, where we differ slightly is that we also believe equity markets will be adversely affected as well, and some of these monies could indeed find themselves into the gold and silver space if they don't go into the crypto space, that is." Now, UK research firm Capital Economics falls into the bearish camp for gold. They assess gold will fall to $1,600 by the end of the year as the Federal Reserve looks to raise interest rates, thereby pushing real rates higher, and also a stronger US dollar will act as a headwind against precious metal prices. Now, for those of you who like to see more bullish news, Jeff Clark, who submits commentary to Gold Silver, a channel I'm sure many are familiar with, believes that the minimum high for gold in 2022 will be $2,100, and a potential high with no crisis, $2,250, and potential high with a crisis, $2,500. He also forecasts that the likelihood gold is higher this year is 90%. Okay, so we have a range of opinions where people believe gold will perform. It's going to fall between $1,500 at the lowest level and $2,250 at the highest, with $2,500 if Russia does invade the Ukraine. Now, interestingly, we thought we would do what we call in the UK the fag packet test. This is where you write some quick figures on the back of a fag packet. And sometimes it's quite extraordinary how the results of doing this can often lead very close to actually what occurs. If we bear in mind that gold will move between $50 and $75 over a quarter period, unless something exceptional happens, it would be reasonable to expect that in the course of a year, we're pretty safe in assuming that gold will therefore rise no more than $300. In other words, 75 a quarter times 4, and fall no less than $300 from its current level. This in itself would give one an upper area for gold at around 2,200, and a lower level of 1600. Now, if you add possibly 10% for extraordinary circumstances and potential black swans, we then have a maximum price of gold at 2,420 and a minimum price of 1,440. If you look, that's not way out of sync with the most pessimistic bank forecast of 1,500. So you've got 1,440 versus 1,500, and the most optimistic, what we would say sensible quotation, of 2,500. So the fag packet says 2,420. So where do we see gold moving this year? And we assure you, we don't smoke, so we're using no fag packets. Well, gold has been comfortable for some months, between 1750 and 1850, and moved out of this range to the upside due to Russia and Ukraine. Added to that, of course, the lack of belief that the Fed can curb inflation fast enough without seriously damaging the rather fragile economy has also helped gold prices. Our analysis indicates a stronger period for gold in the first half of 2022 than the second. We assess that gold could indeed touch $2,100 this year, and should there be an invasion by Russia, a rise as high as $2,330 cannot be ruled out. If no invasion takes place, then we do expect to see gold prices still reach 2,100 in the first half of 2022, but then descend potentially to as low as 1,650 towards the end of the year. That said, though, we would not be surprised to see gold stand between 1,800 and 1,900 on the last day of 2022. That's our forecast for gold. It's going to range generally between 1,650 and 2,100, with a possible blip up should there be an incursion. What are your thoughts? Do share. Do you agree with us or disagree? We look forward to your comments, but meanwhile, please subscribe to the channel, press the bell sign so you're notified of our videos, and we will not this week be producing regular morning videos, and we apologize for that as we need to get the gold and silver forecasts out, and we're going to do a few scheduling changes over the next couple of weeks, which we will advise you of shortly. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.